Most traders think strategy makes them rich, but Van K. Tharp proved it's actually your system and psychology that create financial freedom. What separates traders who consistently win from those who keep blowing up their accounts? And what powerful principles from Trade Your Way to Financial Freedom are almost never talked about? In this audiobook, we will break down Van Tharp's most transformative lessons, from position sizing and risk control to building a trading system that matches your personality. Ever wondered why two traders using the same strategy get completely different results? This book explains exactly why and how to finally trade in a way that works for you. By the end, you'll understand the core principles Tharp teaches that help traders achieve real consistency and start moving toward true financial freedom through trading. Imagine waking up tomorrow morning, walking to your window, pulling the curtains open, and realizing something extraordinary. You don't have to rush anywhere. No deadlines, no boss, no alarm clock dictating your day. You have complete freedom, the freedom to choose how you spend your time, where you live, and what you create. That level of freedom isn't purchased with a lottery ticket or inherited from luck. It's built. And the foundation of building it lies not in working harder, but in learning how to trade your way to financial independence. This is the core message of Van K. Tharp's iconic book, Trade Your Way to Financial Freedom, a book that became a roadmap for traders around the world, from Wall Street hedge fund managers in New York to retail traders in Los Angeles, Chicago, Dallas, and beyond. Tharp challenges the traditional beliefs about money and reveals a truth most people never learn. Wealth doesn't belong to the smartest, the loudest, or the luckiest. It belongs to those who follow a system. Before we dive in, let's destroy one myth most people believe as absolute truth. Success in trading depends on finding the right strategy. Most beginners chase strategies like people running through a mall, searching for the perfect pair of shoes. They try something today, switch to something new tomorrow, flip indicators on and off, jump between YouTube gurus, and hope for a miracle setup. But Tharp reveals something shocking. The strategy is not the most important part of trading. In fact, it's one of the least important parts. What actually determines success is you, your psychology, your discipline, your risk management, and your ability to build a personalized system that fits the way you think, you approach decisions, and you handle pressure. Two traders can use the exact same strategy, but one will become wealthy and the other will blow their account. The difference isn't the system. The difference is the trader behind it. Tharp says something powerful. You do not trade the markets. You trade your beliefs about the markets. That means if you believe trading is risky and unpredictable, you will behave fearfully and inconsistently, and the market will punish you. If you believe trading is a skill that rewards discipline, structure, and patience, you will grow. What you believe shapes what you do, and what you do shapes your results. Trading is a psychological game disguised as a financial one. Let's step into a real example. In 2020, two traders, Daniel and Mia, began trading Bitcoin around the same time. They both had access to the same charts, the same exchange, and the same strategy. When the market dipped, Daniel panicked, closed early, and turned a winning idea into a loss. Mia followed her rules, held her position, and let her trade unfold. She made thousands. He lost. Same system, different psychology. The system was not the problem. Daniel was. Tharp teaches that every trader must begin with self-awareness. Before learning strategies, indicators, or market patterns, you must understand your relationship with risk, uncertainty, and decision-making. Trading is not about predicting the future. No one can do that consistently. Trading is about managing yourself in uncertainty. Your job is not to know what will happen. Your job is to manage what could happen. This leads to one of the biggest lessons Tharp delivers. Risk management is the foundation of trading success. Not entries, not exits, not indicators. Risk. Most traders obsess over how much they can make. Professionals obsess over how much they can lose. Because if you control your loss size, your wins eventually take care of themselves. If you risk too much, emotion takes control and your system collapses. If you risk correctly, fear disappears and clarity rises. But here's something most people never consider. Financial freedom is not about making a fortune once. It's about building wealth consistently and systematically with repeatable actions that compound over time. Tharp teaches that trading must be treated like a business, not a hobby. Businesses have plans, structure, risk controls, budgets, performance tracking, growth goals, systems, and accountability. Traders who treat trading like entertainment lose. Traders who treat trading like business owners win. Think about an airplane pilot. A pilot follows a checklist before every flight, even after thousands of hours of experience. They don't rely on emotion or memory. They follow a system. They do the same thing every time because consistency is the only path to safety. Trading is the same. And that's why Tharp introduces the concept of a trading system, something far more powerful than a strategy. Strategies describe how you trade. A system describes everything around trading: your risk rules, position sizing, routine, setup criteria, journaling, performance tracking, and growth planning. Systems create predictability. Systems eliminate impulsive decisions. Systems build consistency. Imagine two traders again. Trader A has no system. They wake up, open their phone, check charts emotionally, see a green candle, FOMO in, panic when price dips, exit early, then re-enter at the worst moment out of frustration. Their trading day is chaos. Trader B has a complete system. Wake up, review market conditions, check watch list, identify zones, set alerts, enter only when system conditions align, log every trade, review performance weekly, calm, structured, professional. Trader A is gambling. Trader B is building financial freedom. The market will always take money from the emotional and give it to the disciplined. And here's the truth Tharp drives home. Anyone, absolutely anyone, can achieve financial freedom through trading if they commit to building a system and mastering themselves. You don't need to be a genius. You don't need to start rich. You don't need perfect predictions. You need discipline, a process, and the willingness to evolve. This book and this audiobook journey is not about making you feel inspired for a moment. It's about building skills that last a lifetime, skills that give you control over your financial destiny. And now that we've set the foundation, the mindset and philosophy behind trading like a professional, it's time to go deeper. In the next chapter, we explore one of the most transformative topics in the entire trading world: position sizing, the secret weapon that separates millionaires from blown accounts. Because your path to financial freedom doesn't begin with finding the right entry. It begins with learning how to control risk like a master. If you were to ask a room full of successful traders what the most important element in trading is, most beginners might guess strategy, technical indicators, chart patterns, or even market predictions. But experienced traders, the ones who've survived multiple bull and bear cycles, the ones who built portfolios instead of blowing accounts, would give you a different answer. They would tell you that the real secret to long-term success is position sizing. Van K. Tharp makes his point very clear. Position sizing, more than any other component of trading, determines whether you become profitable or go broke. Most new traders never understand this. They believe winning depends on finding the perfect entry or the perfect strategy. They focus on chasing high win rates, trying to be right all the time. But Tharp exposes a truth that shocks most beginners. You can make a fortune with a low win rate if your position sizing is correct. And you can blow your entire account with a high win rate if your position sizing is reckless. In other words, it's not how often you win. It's how much you win when you're right, and how little you lose when you're wrong. Position sizing answers the most important question in trading. How much should you put into a trade? That single decision determines your emotional stability, your long-term survivability, and your ability to compound capital responsibly. When beginners lose money, they blame the market. They blame timing. They blame the strategy. Very few ever stop to look at the real source of destruction: risking too much. Here's an example. Imagine two traders, Lily and Jacob. Both have a strategy that wins only 40% of the time, meaning they lose more trades than they win. That sounds terrible, right? But watch what happens. Lily risks only a very small controlled amount per trade. Her losses are small and consistent, but when she wins, her winners are much larger compared to her losses. Even though she loses more often than she wins, her account grows slowly and steadily. Jacob, on the other hand, risks a huge portion of his money on every trade because he wants big results quickly. When he wins, the results look incredible, and he feels unstoppable. But eventually, when a loss comes, and it always comes, it wipes out weeks or even months of progress. He spirals. He increases risk again, trying to recover, and eventually his account collapses. Same win rate, same strategy, different position sizing. One becomes profitable, one is destroyed. Tharp uses examples like these throughout his book to show why risk control is the foundation of financial freedom. Without it, trading becomes emotional chaos. But with it, trading becomes systematic, calm, and scalable. Position sizing isn't about limiting growth. It's about unlocking growth by protecting your capital. When risk is controlled, something powerful happens. Fear disappears. When fear disappears, clarity appears. And when clarity takes over, decision-making improves dramatically. You stop hesitating. You stop chasing. You stop panicking. You become consistent. And consistency is the gateway to scaling. There is a famous story within the trading world about a legendary experiment conducted by Richard Dennis, the Turtle Traders experiment. Dennis believed great traders could be trained from scratch simply by following rules and position sizing discipline. He took people with no trading experience, taught them risk control and sizing, and within months they were producing professional-level results. They didn't become good because they predicted markets. They became good because they followed a controlled system. Tharp highlights that trading success is not about being right. It's about managing losses intelligently. Losses are not failures. Losses are business expenses. Just like companies budget for cost, traders must budget for drawdowns. Position sizing is how you ensure those drawdowns never destroy you. Think about this. If you risk too much on a trade and lose, your emotions explode. Your heartbeat accelerates. Your mind panics. You lose clarity. And once your mind is unstable, every decision afterward becomes emotionally driven instead of strategically guided. That's how accounts blow up. But if your risk is small and controlled, a loss doesn't feel like catastrophe. You stay calm, you stick to your plan, you continue trading with strength. Position sizing protects not only your money, but your psychology. And psychology controls everything. There is another massive advantage position sizing gives you: survivability. Most traders never experience long-term success because they never give themselves enough time to grow. They take huge risks trying to make money fast, and they burn out early. The legendary investor George Soros once said, "It's not whether you're right or wrong that matters, it's how much you make when you're right and how little you lose when you're wrong." That quote perfectly summarizes Van Tharp's teachings. Trading is not a battle of intelligence, it's a battle of discipline. The trader with better risk control always defeats the trader with better prediction skills. And here's the most inspiring part: position sizing levels the playing field. You don't need a massive account to begin your journey. You don't need to take huge risks to feel progress. You simply need consistency. Small, steady gains compound into something extraordinary over time. Financial freedom is not built through one giant win. It is built through hundreds of small, controlled actions repeated with discipline. As Tharp explains, great traders don't trade to get rich quick. They trade to build wealth for life. They don't chase the next big trade. They protect their capital so they can keep trading tomorrow. Imagine a builder constructing a skyscraper. They don't start pouring concrete randomly and hope for the best. They start with a foundation strong enough to support the enormous structure above it. Position sizing is that foundation. Without it, everything collapses. With it, anything is possible. Now that you understand the transformative importance of position sizing, it's time to explore another critical dimension of Tharp's philosophy: the role your beliefs play in every decision you make. Because your system means nothing if your beliefs sabotage your actions. In the next chapter, we step inside the mind of a trader and discover how rewiring belief systems can turn internal chaos into external wealth. The journey continues, and this is where transformation truly begins. If there is one lesson from Van K. Tharp that stands above all others, it is this: your beliefs determine your results, not the market, not your broker, not your strategy, not your indicators, your beliefs. Every decision you make in trading, when to enter, when to exit, how much to risk, whether to obey discipline or break rules, is driven by the internal scripts running inside your mind. Trading isn't just numbers and charts, it is a mirror, and it reflects back exactly who you are. You don't trade the market, you trade your beliefs about the market. Think about that for a moment. Two traders can stare at the same chart at the same time. One sees opportunity, the other sees danger. One sees a breakout, the other sees a trap. One sees reward, the other sees risk. The chart didn't change. The market didn't change. Their beliefs did. Their internal worlds shape their external decision. And in trading, decisions determine destiny. Tharp explains that beliefs are invisible forces, mental programs installed through childhood, culture, education, social environment, and personal experience. Most people never stop to question those beliefs. They operate automatically. And when brought into trading, they become dangerous. If you grew up believing money is scarce, you will hesitate to risk. You will exit trades early to protect what you have. If you believe wealth is luck, you will trade emotionally and hope instead of plan. If you believe success requires perfection, you will fear losses and sabotage yourself. If you believe trading is gambling, you will behave like a gambler. Beliefs become behavior. Behavior becomes habit. Habit becomes results. Let's examine how beliefs control actions through a real example. A beginner trader named Ryan enters a trade with a great setup. Everything aligns. But as soon as the market moves slightly against him, a normal fluctuation, his childhood belief that losing money is failure kicks in. Panic takes over. He exits early. Minutes later, price moves exactly as expected and hits the profit target. Ryan had the knowledge, he had the strategy, he had the setup, but his belief, not the market, destroyed his outcome. A different trader, Emma, enters the same setup, but her belief is different. She believes losses are simply part of the process, not something to fear. She believes following her plan matters more than feeling safe. She holds the trade. It reaches target. She grows. Same entry, same chart, same information, different belief, different results. Tharp emphasizes that before you can master the market, you must master yourself, your fears, your expectations, your emotional responses, and your internal programming. The journey to financial freedom begins inside long before it shows outside. One of the most damaging beliefs traders carry is that losses are personal failures. We are trained in school that mistakes are punishable and success means being right. But trading flips that completely. In trading, success means managing losses professionally, not avoiding them. Losers try to avoid losses. Winners accept losses quickly and move forward. Imagine a surgeon refusing to stop a procedure because stopping would mean admitting something went wrong. The patient dies. That is what traders do when they refuse to take stop losses. They let ego destroy the account. Taking a loss is not defeat. It is control. It is expertise. It is protection. Another destructive belief is the belief in certainty. The idea that good traders predict the future perfectly. Tharp teaches that predicting is impossible. Success in trading has nothing to do with predicting every move. It comes from managing risk under uncertainty. Your job is not to know what will happen next. Your job is to execute your plan regardless of uncertainty. That belief shift alone transforms traders. They stop needing certainty and begin trusting systems. They stop forcing trades and begin waiting for probabilities. They stop reacting emotionally and begin acting strategically. Tharp also explains that beliefs can be upgraded. You're not stuck with the beliefs you inherited. You can rebuild them through awareness, journaling, affirmations, meditation, coaching, and experience. Just as athletes train their bodies, traders must train their minds. A professional trader believes the market is opportunity, not threat. Losses are business expenses, not disasters. No single trade matters, only the process matters. Discipline is freedom, not restriction. Consistency beats excitement. Once these beliefs become automatic, trading becomes quiet, calm, and structured. The frantic emotional roller coaster disappears. Confidence replaces anxiety. Patience replaces urgency. Logic replaces impulsiveness. And results become stable. Here's a turning point Tharp emphasizes. Your beliefs about yourself become your financial ceiling. If you believe you don't deserve wealth, you will sabotage gains. If you believe you are unlucky, you will trade emotionally and prove yourself right. If you believe making money must be hard, you will resist simplicity. This is why some traders grow accounts beautifully until they reach a certain number, then collapse. Their beliefs reject success. Their mindset wasn't built for prosperity, only survival. To break this ceiling, you must rewrite the script. You must believe that wealth is normal, that success is achievable, and that consistency is possible. Because beliefs shape identity. Identity shapes decisions. Decisions shape results. Results shape freedom. Trading is not just a financial journey. It is a psychological evolution. And now that you understand the role of beliefs, the next chapter takes us deeper into the internal design that creates successful traders. Building your personal trading system, the structured environment where beliefs, risk, strategy, and execution become a unified blueprint guiding every move. In the next chapter, we begin constructing the architecture of your trading machine, the system that will carry you from uncertainty to clarity, from randomness to mastery, and from survival to independence. The blueprint begins now. Up to this point, you've learned that trading success doesn't come from finding a magic strategy or predicting the market perfectly. It comes from mastering yourself, controlling risk, and shaping beliefs that support disciplined decision-making. And now we arrive at the stage where all those pieces come together. The creation of your personal trading system, the heart of Van K. Tharp's work, and the true engine behind financial freedom. A trading system is not just a strategy, it is an entire structure. A framework that determines exactly what you trade, when you trade, how you manage risk, how you measure performance, and how you continuously improve. Your system is the machine that removes randomness and replaces it with predictable, repeatable behavior. Without a system, trading is chaos. With a system, trading becomes clarity. Tharp explains that every trading system must answer three foundational components: which markets to trade, when to enter trades, and when to exit trades. But that's only the beginning. A complete trading system also defines risk parameters, position sizing rules, review processes, emotional control guidelines, performance expectations, and continuous improvement loops. Think of a pilot preparing for takeoff. Even after thousands of successful flights, they follow the exact same checklist. They don't rely on instinct. They rely on system. If they forgot even one step, lives are at risk. A trader should think the same way. A system protects your capital the same way a flight system protects passengers. Let's break down what a powerful trading system looks like in the real world. Not in theory, but in the experience of a professional. Imagine a trader named Alex. Alex trades Bitcoin and Ethereum on the 4-hour chart using a trend continuation approach. But what makes Alex successful is not the setup he trades. It's the precision of his system. Every morning at the exact same time, Alex reviews market structure, checks trend direction across higher time frames, and marks support and resistance zones. He updates his watch list and sets alerts. He enters trades only when price retests key levels, with confirmation from volume and candlestick patterns. His stop loss is always placed below structure. His risk is always 1% per trade. His take-profit targets are predetermined. After every trade, he journals results and emotional responses. None of this is emotional. None of it is improvisational. Every step is written, practiced, repeated. And because Alex follows a system, his results are stable. Now imagine a different trader, Kevin. Kevin trades based on feeling. He enters when something looks good. He exits when he feels nervous. He risks random amounts. He changes his style constantly. He doesn't journal. He doesn't know what works and what doesn't. His results swing violently. His growth is unstable. His system is chaos. Because he has no system, Alex becomes financially free. Kevin remains stuck. That difference has nothing to do with intelligence. It has everything to do with structure. A trading system must begin with clear trading objectives. What is your goal? Is it consistent monthly growth? Is it outperforming inflation? Is it replacing income? Systems without goals drift aimlessly. Systems with goals evolve intelligently. The next component is market selection. You must choose which assets you specialize in. Professionals don't trade everything. They master a few markets deeply: Bitcoin, Ethereum, top altcoins, or specific sectors. Specialization builds expertise. Generalization builds confusion. Then your system must define your entry criteria. Every entry should follow predetermined rules: trend alignment, key level touches, candle patterns, volume confirmation, indicator agreement, or whichever elements form your setup. Entries are mathematical, not emotional. Then comes your exit criteria, both profit exits and loss exits. You never exit based on how you feel. You exit based on rules: structural breaks, target zones, trailing stops, time-based exits, or scaling strategies. Exits are where profit is made or lost. Your system must also include position sizing rules. Tharp teaches that position sizing is the most important part of a system. Without risk limits, even the best entry rules are worthless. Position sizing transforms trading from gambling to controlled compounding. Then comes something many traders ignore: system beliefs and psychological controls. You need rules for mindset as much as strategy. When do you take breaks? What emotions stop you from trading? What triggers cause impulsive mistakes? What rituals ground your focus? A system without emotional discipline collapses when stress arrives. Next is performance tracking. The journal. Journaling isn't optional. It is the mirror that shows truth. It reveals patterns invisible in real time. It turns experience into knowledge. Without a journal, improvement is impossible. Finally, a trading system must include continuous optimization. Systems evolve. Markets shift. Conditions change. Professionals adjust through testing and evidence. Beginners rewrite everything impulsively and lose. Refinement is slow, data-driven, patient. Tharp states something profound. A great system should allow ordinary traders with discipline to outperform brilliant traders without discipline. The system becomes the source of confidence. Confidence doesn't come from wins. It comes from knowing exactly what to do next. When you have a system, doubt disappears, hesitation disappears, fear weakens. You execute, you wait, you review, you improve. Success becomes mechanical instead of magical. One day something incredible happens. You stop feeling emotionally attached to individual trades. You stop chasing, you stop rushing, you stop reacting. Trading becomes calm and controlled. Wins and losses become statistics. The game becomes mathematical. You become a professional. And when that moment arrives, financial freedom stops being a dream. It becomes inevitable. Now that we've laid the foundation for designing your personal trading system, the next chapter explores one of the most transformational topics in the entire book: expectancy, the formula that turns your system into predictable profitability and reveals whether your approach will grow your account or destroy it. There is a moment in every trader's journey when they finally step away from emotional reactions, away from hope and fear, and into the world of statistical logic, where trading becomes a numbers game instead of a guessing game. Van K. Tharp calls this moment the awakening, and its trigger is a concept most traders have never heard of. Yet it determines whether your trading system will make you a fortune or slowly destroy your account. That concept is called expectancy. Expectancy is the mathematical heart of trading. It measures how much money you can expect to make or lose per trade over a large number of trades. It tells you whether your system is profitable or broken, whether you should scale aggressively or retreat for refinement. Instead of relying on hope or emotion, expectancy gives you a quantifiable truth. With expectancy, you no longer wonder if your strategy works. You know. Losses don't matter. Wins don't matter. Random streaks don't matter. Outcomes of individual trades don't matter. What matters is the average result across many trades. Here's the expectancy formula Tharp teaches. Expectancy equals win rate multiplied by average win minus loss rate multiplied by average loss. Let's break that down in real terms. Imagine a trader named Sophia. She wins only 40% of her trades, meaning she loses more than she wins. That sounds terrible by beginner standards, but her average win is 3 times her average loss. So mathematically, win rate is 40%, average win is $300, loss rate is 60%, average loss is $100. So expectancy would be 0.40 multiplied by 300 minus 0.60 multiplied by 100, which will come to 120 minus 60, which will be $60. On average, every trade she takes earns $60. Even though she loses more trades than she wins, that is a profitable trading system. Now consider another trader. Mark. He wins 70% of his trades, which looks amazing on the surface. His win rate feels impressive. His confidence is high. But average win is $100, average loss is $400. So expectancy would be 0.70 multiplied by 100 minus 0.30 multiplied by 400, which will come to 70 minus 120, which will be negative $50. Even though Mark wins 7 out of 10 trades, he loses on average $50 per trade. He is a losing trader, not because of strategy, intelligence, or prediction ability, but because his risk structure is broken. His system is mathematically doomed. This is the shocking truth Van K. Tharp reveals. A trader who wins less but controls losses will always beat a trader who wins more but loses big. Expectancy doesn't care about ego. Expectancy doesn't care about looking smart. Expectancy doesn't care about the excitement of winning streaks. Expectancy cares only about numbers, and numbers never lie. Most beginners obsess over win rate. They chase strategies with 80 or 90% accuracy because it feels powerful. But high win rate systems often produce catastrophic losses when they fail. They look stable until they explode, like a fragile glass tower standing tall until one crack takes it down. Professionals prefer expectancy over accuracy. Beginners prefer excitement over expectancy. Here's the psychological brilliance in Tharp's teaching. Expectancy removes emotional attachment to single trades. When you understand expectancy, a loss means nothing. It's simply part of the statistical curve. One win means nothing, one loss means nothing. What matters is executing edge repeatedly. Take this key idea from Tharp. You are not trying to win every trade. You are trying to win over a series of trades. Trading becomes a long-term game, a process, a probability engine. Expectancy allows you to think like a casino, not like a gambler. Casinos don't care who wins or loses tonight. Casinos care about the long-term statistical edge built into every game. That edge guarantees profit across thousands of plays. A successful trader is a casino, not a player. That means your job is simple. Find a positive expectancy system, execute it consistently, control risk. If expectancy is positive, time and consistency do the rest. If expectancy is negative, no amount of hard work or emotional effort can save the system. Expectancy also gives you the ability to scale safely. Once your system shows a strong positive expectancy across a large sample of trades, you can begin increasing position size strategically. You no longer rely on hoping a month will go well. You trust the math. Expectancy transforms uncertainty into confidence. It transforms chaos into structure. It transforms confusion into clarity. Once you understand expectancy, you stop asking, will this trade win? And you start asking, does this trade align with my edge? One is emotional, the other is professional. This is the turning point where traders separate from the masses. When trading begins to feel boring, mechanical, calm, controlled, predictable, you are stepping into mastery. High-level trading isn't exciting, it's disciplined, it's structured, it's data-driven, and that's why it works. Now that you understand expectancy, the mathematical backbone of profitability, it's time to explore one of the most misunderstood elements of Tharp's philosophy, the role of mistakes. Because mistakes aren't failures, they're feedback, they're fuel. They're the blueprint for evolution. In the next chapter, we step into the world of error correction and learn how elite traders accelerate growth not by avoiding mistakes, but by mastering them. There is a moment in every trader's journey when they realize something profound. Success doesn't come from avoiding mistakes. It comes from learning how to transform mistakes into improvement. Van K. Tharp dedicates a powerful segment of Trade Your Way to Financial Freedom to this truth. He explains that elite traders are not defined by perfection. They are defined by how they respond when things go wrong. Mistakes are not obstacles. They are opportunities. They are signals guiding you to refinement. They are the foundation stones of mastery. Most beginners try desperately to avoid mistakes. They fear being wrong. They fear losing. They fear looking foolish. Because the world we grow up in trains us to believe that mistakes equal failure. In school, mistakes cost you grades. In childhood, mistakes earn punishment. In society, mistakes trigger judgment. But trading flips that belief completely upside down. In trading, mistakes are your greatest teacher. Tharp makes it clear, there is no such thing as a perfect trader. Every trader makes mistakes. Every trader experiences drawdowns. Every trader faces confusing markets, emotional pressure, and unexpected outcomes. The difference between successful traders and struggling ones is not the absence of mistakes. It is the presence of learning. Beginners repeat mistakes endlessly because they do not analyze them. Professionals evolve because they study them relentlessly. Mistakes are feedback. Feedback is information. Information is power. Let's step into a real story to understand this deeply. A trader named Lucas entered a beautifully structured setup on Bitcoin. Trend direction aligned, a perfect retest formed, volume confirmed, and his analysis was sharp. But instead of setting a stop loss according to his plan, he widened it dramatically because he wanted to give the trade room to breathe. In reality, he was afraid to lose. When price moved against him, Instead of exiting logically, he held, hoping it would bounce. The loss grew bigger and bigger until the pain became unbearable, and he finally closed with a large hit to his account. What was the real mistake? Not the market, not the strategy, not the setup. The real mistake was breaking his system out of fear. His journal later revealed that almost all his losses came not from bad analysis, but from violating rules. The mistake wasn't losing, it was abandoning discipline. Once he realized this pattern, he corrected it, and once corrected, his consistency returned. That is the essence of Tharp's teaching. Mistakes are not problems. Unexamined mistakes are. The only real failure in trading is failing to learn. Tharp encourages traders to treat mistakes scientifically. Scientists do not get emotional when an experiment fails. They analyze the data, they refine the formula, they run the test again, they improve. The process is iterative. That mindset is exactly what traders must adopt. Mistakes are messages. They reveal weaknesses in your system. They expose belief conflicts. They highlight emotional triggers. They show where refinement is needed. A trader who studies mistakes grows rapidly. A trader who avoids looking at mistakes stays stuck forever. Another powerful insight Tharp emphasizes is responsibility. Traders often blame external factors: the market, news events, manipulation, influencers, brokers, exchanges, volatility. But blaming the external world blocks growth. You cannot fix what you refuse to own. When you take full responsibility, total, complete ownership, something transformative happens. You gain control. You stop feeling like a victim. You begin shaping your evolution. Responsibility creates power. Excuses create paralysis. When you say, "I lost because the market was manipulated," you learn nothing. When you say, "I lost because I entered emotionally, I violated my rules, I ignored risk," you gain the blueprint for future improvement. Mistakes also reveal emotional patterns: fear, greed, FOMO, revenge trading, hesitation, impatience. Each emotional response leaves a trail inside your journal. Over time, you begin to see trends not just in price action, but in your own psychology. You discover that certain situations trigger poor judgment. Maybe you rush into trades after losing. Maybe you exit early because you fear giving back profits. Maybe you risk more when you feel confident and implode during reversals. Once identified, these emotional patterns can be controlled. Once controlled, trading becomes stable. Here is a quote from Van K. Tharp that captures this chapter beautifully. "Every mistake is a chance to discover something about yourself. If you learn from mistakes, they cease to be mistakes." This redefines how traders view losses. Losses stop being emotional pain and become tuition, the price you pay for skill development. Trading becomes internal growth disguised as financial growth. The market is not your enemy. The market is your teacher. The most successful traders in the world speak openly about their mistakes. They analyze them brutally. They document them carefully. They transform them into progress. This is how mastery is built. Consider how professional athletes review game footage. They watch their errors frame by frame. They study weaknesses with precision. They rehearse corrections. They internalize improvement. Trading is no different. Your journal is your game footage. Your mistakes are your training blueprint. Your discipline is your long-term advantage. There is one more key lesson in this chapter. The faster you process mistakes, the faster you grow. Traders who hide from mistakes prolong their suffering. Traders who face mistakes accelerate success. Growth doesn't come from winning. Growth comes from recovering correctly when losing. This chapter marks a shift from emotional to analytical, from reactive to strategic, from fragile to resilient. Once you stop fearing mistakes, trading becomes freer. When mistakes stop hurting, results stop swinging wildly. And when mistakes become learning opportunities, your path to financial freedom accelerates. Now that you understand how to convert losses into progress, it's time to explore another transformational concept: position sizing strategies for scaling your system into larger profits. The next step on your roadmap to freedom. You now understand how crucial mistakes are, how expectancy drives your system, how beliefs shape your decisions, and how risk control forms the core of professional trading. With these foundations in place, we enter one of the most powerful ideas in Van K. Tharp's work: position sizing as the engine of exponential growth. If position sizing is the shield that protects your capital, scaling is the sword that allows you to expand it. This is where traders evolve from survival to dominance, not by trading more often, not by chasing bigger wins, but by increasing capital intelligently while maintaining emotional stability and system consistency. Most traders think scaling is simply increasing trade size. They think growth means doubling position size and make more money. But scaling is a science, not excitement. Scaling is gradual, measured, mathematical, and rooted in psychological readiness. The purpose of scaling is not to get rich fast. It is to increase returns while maintaining the same risk profile per trade. If your strategy has a positive expectancy, scaling multiplies it. If your system is broken, scaling multiplies damage. That's why scaling is the final stage, not the first. Van K. Tharp introduces several position sizing strategies that professional traders use depending on their goals and emotional tolerance. The first is fixed fractional position sizing, the most stable and widely used approach by elite traders. It means risking a fixed percentage of capital on each trade, typically between 1 and 2%. If your account grows, your position size grows automatically. If your account falls, your position size shrinks. The system self-corrects, protecting you in losing periods and accelerating growth in winning cycles. Here's a real example to see the power of this approach. A trader named Will begins with a $5,000 account and risks 1% per trade, $50. After weeks of consistent execution, his account grows to $10,000. Now 1% becomes $100. A year later, his account reaches $50,000. Suddenly 1% becomes $500. Will never change his risk percentage, yet his position size increased 10 times. And every profitable trade rewarded him exponentially more. That's the beauty of compounding. It multiplies success quietly, steadily, and powerfully. The second method is fixed dollar position sizing, where a trader risks the same dollar amount regardless of account size. For example, always risking $100 per trade. This creates emotional stability for newer traders who need consistency more than acceleration. It prevents emotional overwhelm when scaling too quickly. Once confidence grows, traders shift to fractional risk models. Then there is volatility-based position sizing, used heavily in crypto because volatility can be extreme. Here, position size adjusts based on average price movement. When volatility rises, position size shrinks to protect capital. When volatility contracts, size increases to maximize opportunity. This method is advanced, but it protects traders from sudden market shocks, something every crypto trader eventually faces. Tharp also discusses equal risk position sizing, where trades are structured so every position has the exact same dollar risk after accounting for stop-loss distance. Instead of randomly choosing quantity, professional traders calculate position size mathematically. This standardizes losses and stabilizes emotional responses. But the most powerful concept Tharp emphasizes is this: position sizing creates equity curves. Two traders trading the same system can produce completely different financial results based solely on how they scale. Someone who risks too much early will experience emotional collapse. Someone who risks too little forever will grow too slowly. But someone who scales in alignment with system performance achieves controlled exponential growth. The formula behind every millionaire trader. Scaling must always follow performance, not emotion. Beginners scale up when they feel lucky, right after wins, and scale down when fearful, right after losses. Professionals do the opposite. They scale based on statistical data. They increase size only after consistent profitability across a large sample. They decrease immediately in drawdowns to protect mental and financial strength. True scaling mastery is psychological. A $50 loss may feel insignificant. A $5,000 loss may shake a trader to their core. The numbers change. The emotions amplify. The discipline must remain unchanged. Here's a real example illustrating emotional scaling failure. A trader named Ethan built his account from $1,000 to over $15,000, trading responsibly. Feeling confident, he dramatically increased risk size, expecting his growth to snowball. But when the market dipped, he froze emotionally. He couldn't close his losing trade because the loss number terrified him. What once was a small, manageable setback became a devastating emotional punch. His plan collapsed. His discipline evaporated. His account quickly fell back below $5,000. Not because his system failed, but because he scaled emotionally instead of strategically. Scaling is not about speed. Scaling is about control. Financial freedom through trading is not built by a miracle moment. It is built by a compounding process. Van Tharp teaches that traders must choose their goals deliberately because position sizing is the tool that turns goals into measurable outcomes. If your goal is steady compounding, fractional sizing is ideal. If your goal is aggressive growth with controlled risk, volatility sizing adds precision. If your goal is emotional neutrality, fixed dollar sizing builds confidence. Every position sizing approach is a system. Every system determines emotional stability. Emotional stability determines long-term success. Scaling also marks the transition from trader to portfolio manager. You stop thinking about individual trades and begin thinking about overall equity growth. You stop chasing a big win and start compounding hundreds of controlled wins. Your identity shifts. You stop being a hunter chasing opportunity and become an investor managing probability. Success becomes inevitable when your plan becomes mechanical and your emotions become quiet. The market stops feeling like war and begins feeling like business. Now that you understand scaling and growth mechanics, we are ready to move into one of the most profound segments of Tharp's work. Something that separates wealthy traders from those who fail repeatedly. Creating objectives and setting performance goals that align with your system and personal psychology. Because without clear destination, growth has no direction. And without direction, freedom remains a dream instead of a destination. The next chapter reveals how to turn financial freedom into a measurable plan, and how goals become the compass and accelerator of your trading evolution. The journey continues. Every great journey begins with a destination. You don't pack your bags, get into a car, and start driving endlessly without knowing where you're going. You choose a location, map the route, estimate timing, prepare resources, and monitor progress along the way. Trading is no different. Yet most traders behave like drivers with no map, wandering, improvising, hoping to arrive somewhere meaningful without knowing where there even is. Van K. Tharp teaches that the traders who achieve financial freedom are not the ones who trade randomly or aggressively. They are the ones who build clear objectives and design systems to achieve them. Goals are not motivation slogans. Objectives are not fantasies. In Tharp's world, goals are quantifiable, measurable, time-bound targets built from logic, performance metrics, and personal psychology. A trading objective is a destination that directs your system, focuses your decision-making, and determines how you use risk and position sizing. Without clear objectives, progress cannot be measured, improvement cannot be tracked, and discipline dissolves into chaos. Tharp explains something deeply important. You can only grow what you can measure, and you can only measure what you define. Most traders don't define anything. They say vague things like, "I want to make good money," or "I want to be financially free someday," or "I want to trade full-time." Those statements carry no direction, no deadlines, no metrics. Therefore, they create no progress. Clarity is power. Vague goals produce vague results. Let's step into a real example. A trader named Jenna decides she wants to become financially independent through trading. Instead of simply saying, "I want success," she defines a measurable goal. Achieve an average monthly account growth of 4% across 12 consecutive months, while maintaining maximum risk exposure of 1% per trade and avoiding more than 3 consecutive rule-based errors. She tracks this goal weekly, reviewing performance and adjusting behavior. Over time, improvement compounds. She isn't guessing, she's measuring. She isn't hoping, she's executing. Meanwhile, another trader, Anthony, says, "I want to double my account fast." With no process, no metrics, no structure, he increases position size impulsively, takes low-quality trades, and eventually loses everything. The difference between them isn't luck, it's clarity versus chaos. Tharp introduces the idea of objectives that align with your personal psychology, meaning your goals must fit your emotional tolerance. For example, if you hate stress and cannot handle deep drawdowns, setting a goal of 20% growth per month will break you emotionally and destroy your discipline. But a goal of 2 or 3% per month with gradual compounding may match your personality perfectly and lead to long-term freedom. Goals should stretch you, not break you. They should be ambitious, not unrealistic. They should inspire growth, not trigger panic. Tharp also explains that objectives must support your position sizing strategy. If your goal is slow, steady compounding over years, fractional position sizing is ideal. If your goal is aggressive growth for a small starter account, scaling must be structured and data-backed. Goals define how fast you scale, how often you trade, what assets you choose, and how emotionally demanding your system becomes. There is another powerful principle. Your goal should not be money itself, it should be process. Money is a result, not an action. You don't control profits directly. You control process, and process creates profits. This mindset shift separates champions from beginners. Professional traders build goals like improve discipline by eliminating emotional entries for 30 days, Execute only system-qualified trades for 100 trades. Maintain average loss size below 1R while allowing winners to reach at least 2R. Those objectives guarantee progress regardless of short-term winning or losing. Tharp also emphasizes the importance of performance benchmarks, key measurements that determine progress, such as expectancy, risk-to-reward ratios, drawdown tolerance, and trade frequency. Businesses track revenue, cost, profit margin, and efficiency. Traders must track performance metrics with the same seriousness. One trader may discover that their winning percentage does not matter as long as their rewards are larger than their risks. Another may discover that trading too frequently causes mistakes. Another may discover that their system performs best during specific market conditions or time sessions. These insights only emerge through measured tracking. Without tracking, learning is accidental. With tracking, learning becomes scientific. Let's revisit the metaphor of a pilot. A pilot tracks altitude, direction, airspeed, fuel levels, and route progression. They don't glance occasionally and hope they arrive safely. They monitor constantly. They adjust intelligently. That is what a structured trading objective allows. Continuous navigation toward financial freedom. The moment you define goals clearly, something transformational happens inside you. Discipline becomes easier because direction is clear. Patience increases because you understand long-term progression. Emotional swings weaken because single trades lose importance. Progress becomes visible, and visible progress builds confidence. Confidence is not born from winning trades. Confidence is born from evidence of improvement. Confidence is built when your journal shows reduced rule violations. Confidence is built when your drawdowns shrink in size and duration. Confidence is built when your equity curve stabilizes. Confidence is built through structured growth, not lucky outcomes. There will come a moment when you look back at your journey and realize something profound. You are no longer reacting to the market. You are executing a roadmap. Your success is no longer accidental. It is intentional. And that is the moment your identity shifts permanently. When trading stops being a short-term opportunity and becomes a long-term wealth machine. Now that you've built objectives and direction, the next chapter takes you deeper into a powerful transformation, turning your trading into a business, a structured enterprise designed for scalability, efficiency, and financial independence. Because true freedom doesn't come from trading for income. It comes from building a trading business that runs with discipline and systemization. There is a defining moment when a trader transitions from amateur to professional. The moment they stop thinking like a casual participant and start thinking like a business owner. Van K. Tharp emphasizes that if you want financial freedom through trading, you must treat trading as a real business, not a hobby, not entertainment, and not a casual side project. The market rewards traders who operate systematically and punishes those who operate emotionally. A business has structure, a business has goals, a business has budgets, processes, performance tracking, and continuous improvement cycles. A business manages risk carefully, optimizes operations, and eliminates inefficiency. Most traders do the opposite. They operate without structure, abandon planning the moment excitement appears, and run on hope instead of discipline. They treat trading like gambling, and the market treats them like gamblers, taking their capital slowly or suddenly, but inevitably. To build financial freedom, you must shift identity from trader to business owner. Your trading business requires planning, documentation, review, and professionalism. It must have systems that function even when emotions run hot, because emotional decisions destroy accounts. Let's compare two perspectives. An amateur trader logs into an exchange on impulse, looks at price movement, makes a trade based on feelings and hopes for profit. They rely on adrenaline and intuition. They take trades randomly because they feel pressure to be active. A professional trader begins the day by reviewing market conditions, economic events, volatility, trend structure, and watch lists. They analyze and update levels, set alerts, and predefine rules. They know exactly which setups they are waiting for, and they do nothing until conditions align. Trading is calm, patient, deliberate, and methodical. They execute like a surgeon, not a gambler. They measure outcomes, review performance, and refine continuously. One is chaos, one is business. Tharp explains that a trading business must contain key operational pillars, including a business plan, a trading plan, a risk management plan, and a review and improvement plan. These are not theoretical ideas. They are practical systems that govern your structure. A business plan defines your objectives, income goals, growth goals, drawdown limits, time commitments, capital allocation, and performance standards. A trading plan defines your system, market selection, strategy rules, entry triggers, exit rules, journaling requirements, and psychological guidelines. A risk plan defines maximum loss per trade, maximum daily or weekly loss tolerance, capital protection protocols, and scaling phases. A review plan defines when and how you analyze your results, refine rules, update systems, and measure progress. Without these components, success is accidental and temporary. With them, it becomes engineered and repeatable. Consider how real businesses operate. A restaurant does not change its menu every day out of boredom. A hotel does not change its pricing every hour based on emotion. An airline does not fly without systems, checklists, and contingency protocols. So why do traders constantly change systems, change indicators, jump from strategy to strategy, and make impulsive decisions? Because they have not yet built the identity of a business owner. Tharp also emphasizes that a trading business has costs, and losses are one of them. Losses are expenses like electricity in a factory or marketing in a startup. Nobody shuts down a business because they paid an electricity bill, and no professional trader panics because they took a loss. Losses must be budgeted. Losses must be expected. Losses must be controlled. Traders who emotionally attach to losses turn business expenses into psychological trauma. Successful traders plan for losses and move forward without hesitation. They understand that consistency is created not by winning constantly, but by executing rules constantly. A trading business also requires tools and infrastructure. Professionals invest in quality data, reliable platforms, advanced charting, fast execution systems, journals, and performance analytics. Amateurs rely on random indicators shared on social media. A trading business requires time structure, defined hours of operation. You don't sit at screens all day burning emotional energy. You trade in planned windows, review in structured cycles, and maintain balance to preserve clarity. When trading becomes chaotic and obsessive, performance collapses. One of Tharp's most powerful insights is that a trading business grows through continuous improvement, just like any high-performing organization. Professional traders use performance feedback loops, identify errors, analyze patterns, apply adjustments, optimize rules, and repeat the cycle. Improvement is compounding, just like capital. Every refinement improves expectancy, stability, and growth potential. As your system matures, your trading business evolves into a machine, predictable, controlled, scalable. Instead of reacting to the market, you respond with discipline. Instead of hoping, you execute. Instead of chasing opportunity, opportunity finds you. Here is a secret many never understand. Professional trading is boring, and boredom is profitable. Amateur trading is exciting, and excitement is expensive. When your system becomes boring, scalable wealth begins. When trading feels like emotional entertainment, disaster approaches. And this is the mindset that transforms trading into a true wealth engine. You don't live trade by trade. You live performance cycle by performance cycle. You don't chase instant gratification. You build long-term freedom. And now we arrive at the final chapter, the conclusion of Van K. Tharp's philosophy, where everything comes together. The chapter where identity shifts forever and the roadmap to financial independence solidifies. Becoming the kind of trader who achieves freedom. The trader with discipline, control, patience, and mastery. This is the final chapter, the moment where everything you've learned transforms from theory into identity, where concepts turn into conviction, where trading stops being something you do and becomes something you are. Van K. Tharp teaches that the ultimate key to financial freedom is not strategy, not indicators, not market predictions, and not even risk management alone. The true key is who you become in the process. Because success in trading isn't something you get from the outside. It is something you build from the inside. You don't become financially free by accident or by luck or by catching one magical trade. You become financially free by evolving into the kind of person who makes disciplined decisions, who follows structure, who manages emotion, who treats trading like business, and who executes consistently regardless of outcome. The real transformation in trading happens the moment you stop trying to control the market and start mastering yourself. You cannot control price movement. You cannot control news events. You cannot control trends, but you can control how you respond. You can control how you prepare. You can control what actions you repeat. And that control is the power that builds wealth. Tharp explains that every trader who reaches financial freedom experiences an identity shift. In the beginning, traders believe success is external, the right indicator, the perfect strategy, the lucky moment. Over time, they realize success is internal. Discipline, beliefs, psychology, behavior, and structure. The greatest traders don't chase profits. They chase flawless execution. The greatest traders don't try to win every trade. They focus on following their system perfectly. The greatest traders don't fear losses. They accept them with clarity, review them with honesty, and learn from them scientifically. At the highest level, trading becomes a quiet, controlled, boring process. And that's what makes it powerful. When trading becomes boring, it becomes consistent. When it becomes consistent, it becomes scalable. When it becomes scalable, it becomes freedom. There is a moment every successful trader eventually reaches, a moment where they look at a chart and no longer feel stress or urgency, where they enter a trade and feel calm, where they take a loss and feel nothing but clarity, where they win and feel nothing but execution pride. When this moment arrives, something profound happens. The market loses power over you. You become emotionally untouchable. That is the identity of freedom. This is the transformation Tharp talks about. The evolution from reactive beginner to strategic professional to unstoppable master. Let's revisit a story that represents this transformation. A trader named Daniel spent years trying to trade emotionally. He chased breakouts, fell for social media hype, switched systems constantly, and blew multiple accounts. He believed success was about finding the right strategy. But eventually, after studying Tharp's work, he realized the problem wasn't his strategy. The problem was himself. He rebuilt slowly. He created a system. He mastered risk. He journaled relentlessly. He learned to control his emotions. He stopped trying to be right and started trying to be disciplined. Over time, his equity curve stabilized. He scaled gradually. His life changed, not because the market became easier, but because he became stronger. That is the journey of every trader who reaches financial freedom. It's not the story of genius. It's not the story of luck. It's the story of discipline, repetition, and belief. Here is one of the most powerful messages from Van K. Tharp. You don't work on the market to become successful. You work on yourself. And that is the truth most people never understand. The market is simply a mirror reflecting your psychology. It exposes your weaknesses. It amplifies your beliefs. It rewards structure and punishes impulsiveness. When you learn to control yourself, you control everything that matters. So now, as we close this audiobook, ask yourself a deeper question. Not what strategy should I use, or how much money can I make? Instead ask, who do I need to become to trade with discipline, clarity, consistency, and freedom? Because the moment you answer that honestly and commit to becoming that person, the game changes. Trading isn't a path to fast riches. Trading is a path to personal evolution. Financial freedom is not the destination. It is the result of becoming a master of yourself. You now possess the roadmap, strategy, psychology, risk control, position sizing, expectancy, system building, mistake mastery, scaling science, and business structure. There is nothing else standing between you and the life you want except repetition and discipline. The next chapter of your journey is not in this audiobook. It is in your hands. One day you will wake up with full control of your time, your income, your choices, and your future. You will realize that everything changed not because you discovered a secret, but because you changed. Your freedom begins when you make the decision to execute relentlessly. Your next steps determine everything. Your transformation is already in motion, and this one is where your future wealth begins. Now you know the complete roadmap to financial freedom through trading. But what if I tell you, having the knowledge of only trading will not guarantee success? Trading involves understanding the basics of the stock market to support your trading decisions. To get a complete understanding of the stock market and leverage this knowledge for your trading journey, click on the video popping up on the screen.